Times Influence Initiative.
SIP Day, a unique investor education initiative organized by Kotak Mutual Fund, was celebrated on 18th August 2017. With the theme Financial Freedom, SIP Day in its second edition focused on the benefits of investing early and for the long run in order to secure one's future. To lay the foundation for the main event, a series of financial freedom camps were conducted to help spread awareness about SIPs to different audience, that is milk workers, traders and sculptors. SIP Day aims to empower every Indian to become financially sound. This was seen through a series of talks and panels that were conducted through the day.
This is the season 2 of SIP Day, and we're very proud to share with you exactly a year ago when we kicked off SIP Day season 1, Kotak Mutual Fund set a record, and that record is 30,000 SIPs were registered because of SIP Day. Are we looking at beating that record?
This time the response is fairly encouraging. And more importantly, we are looking forward to bring those set of investors who haven't yet invested in mutual fund. So it's not only the SIPs from the regular customer, which we could get otherwise also, but the focus is to bring that segment of society which has not yet invested in capital markets, equity markets, which haven't yet witnessed the magic of compounding on their portfolio. So we are very hopeful for this SIP Day.
Okay, I hate to start with a very basic question, but what is a SIP?
Equity market is like roller coaster. If you start on a particular point, it takes you up, down, up, down, up, down. And if you can sit in that journey, if you can go through that entire journey, when the journey comes to an end, you feel quite happy, you feel quite blessed. Now SIP, in some sense, is that small, plate of metal which protects you during this roller coaster journey. It's a very commonsensical tool of investing regularly in an equity mutual fund. It's just a discipline of investing on a regular basis some amount. Someday market will be expensive, someday market will be cheap, someday market will be high, someday market will be low. But if you keep on investing over a long period of time, the SIP starts working in your favor. You start benefiting from the volatility of the market. And over 5, 10, 15, 20 years, when you close your SIP to take your money out, you get fairly decent return.
So, is there a good time, age and amount to start a SIP?
When you have money or when you have knowledge, that's the best time to start SIP, including today. There's no better day than today to start SIP. And what we have seen is that if you start early, you really have benefit of compounding in your favor. But we can't go back into the time machine and start SIP backdated. So today is the best day to start SIP, when you have money or when you have knowledge to start an SIP.
Before I hand it back to Pooja, in television we use a terminology called KISS. The acronym for KISS in television language is keep it simple. And I think SIP is nothing else but a very simple way of taking care of your financial future. Right? So with that, let's put our hands together for Nilesh Bhai.
Focusing on women and urging them to become financially independent, a session titled Financially Independent with SIPs was conducted. The panel featured Lakshmi Iyer, Chief Investment Officer of Debt and Head of Products for Kotak Mahindra Asset Management Company. Rupa Venkat Krishnan, Independent Financial Advisor. Sujata Kabraji, Independent Financial Advisor. And was moderated by the Executive Editor of Financial Markets at ET Now, Nikunj Dalmia.
The idea of this discussion is really to understand the psyche of an Indian woman saver. And without me prompting into anything specific, so why do you think, Lakshmi, Indian women are reluctant about saving in equity or debt funds?
Most of India is unaware that there is something like SIP available, number one. Number two is, a few days back, I said that Indian population is 135 crores and number of SIP accounts we have is barely 1.5 crores. To which somebody says that it's not a right comparison because the number of PAN cards is just 1/10 of what the population is. My point is that if you want the SIP, you will get the PAN. It is not that just because you don't have the PAN, you don't have the SIP. So I think the awareness has to spread, and somewhere it is in the mind of a woman that financial planning is not my cup of tea. Okay, if I'm unmarried, it's my family that does it. And if I'm married, okay, let me delegate it to my husband, and he is the person who will take care of it. So I think it's time we disbandon that myth, and probably, and why I'm calling it a myth, because there is absolutely no reality in it. I think it's important to stop giving excuses and start acting, because once the mind decides, the body will find its way to execute things.
Fair point. So, Rupa, two follow-up questions. First, when you talk about Indian women and are they serious about financial saving, do you think there is unawareness or there is fear?
There's basically an insecurity which is there within a lot of women saying that I won't be able to manage money. But in fact, my perception is saying that the women are the best financial managers because they run homes. And inflation hits the women the first through milk prices and vegetable prices. So they know exactly what's about how to run a home, and they are the best financial planners. But the fear is saying that how do I manage it, and do I have the ability to manage it? Secondly, there is a lot of inhibitions when it comes to money or when it comes to investments. People think saying that you need large sums of money to create large sums of wealth. I don't think so. I think that myth has to go away, saying that you only need small sums of money to create large sums of wealth over a period of time. I think these are true concepts, because when it comes to money, you are so ashamed to share with somebody that I only have 1,000 rupees to save or 500 rupees to save to create wealth. I think that myth has to go away. And that's the myth that I find in a lot of people, saying that I have very little, can I make abundance out of it? So it's fear and the inhibitions to share and talk about it.
Sujata, what has been your experience?
I'm seeing a huge big change in the last maybe 4 or 5 years. So I have a team of women who work with me, and they all come from an economically poorer background. And I think what the big change is, if you educate and take away the fear, then I'm finding it hard to hold them back. They want to put everything in equity rather than have a balance. So fear holds women back, and they feel ashamed to admit that they don't know. But once you teach them, I think, like Rupa said, they make better financial planners.
Actually, a very basic follow-up question. Since we are targeting Indian women saver here, Indian women saver are ultra-conservative. They have token amount which they save from their household expenditure, and that is their entire saving or their corpus. Should an average Indian woman saver not invest in equity SIPs at all?
So I think the answer to that is a definite yes. And it's been going, it's a parampara basically, at least in the Indian fraternity, that when a woman is wedded, she gets some sridhan into the household, and that sridhan is typically gold, cash, anything tangible. I think this is the era where this same woman has to inherit sridhan, and that sridhan has to be SIP. So I think basically SIP is definitely the way to go for a woman, specifically to get initiated into the world of finance. It will do wonders to you, much, much beyond your life, and much more beautifully or miraculously than you could have ever imagined. Whereas gold, it's not that I'm against gold, but gold will just lie over there. It's a dead asset. It does not add to the productivity of the country. So it's time women change the mantra that my Sridhan is my SIP.
Now, Rupa, imagine some unnecessary forced purchase which we do either on internet or we go to movie hall, and instead of popcorn we also buy that soda. Now, this is just for the young audience here. If they just avoid the temptation of buying a shoe, one t-shirt or one weekend movie, how much can that save or make their life if they start a SIP?
So normally when I meet a young guy and when I talk about SIP, the first reaction is, I don't have money to save. So I just ask a question saying that how many times do you go to a pub or a hotel or a restaurant? And it would be 5 times and 6 times. And every time that you spend, he says 1,000 rupees or 500 rupees. So I asked him 3 months back, where did you eat? And with whom did you eat? And what did you eat? I don't remember. Not even 2 weeks back, you would remember what you ate or what you did. So I said, fine, if that is the case, if you can give me that SIP, if you go, instead of 4 times, you go 2 times to a restaurant, and the 2 times that you don't go, give me as a SIP. After a few years, I think you will have money to go and pub in a 5-star hotel. That's the kind of wealth that you can create over a period of time and save, and it's all about discipline. I think it changes. It just gives a little time, but it just changed your mind, because investment is all about psychology. It's all about experience. It's all about how do you put yourself.
So I'll keep it open. I mean, we'll encourage some, questions from the floor. And yes, please.
My question is, okay, SIP is for people who have regular income, like salaried people. So what about people who have erratic income? Sometimes they make money in a month, sometimes they don't. They get a deal, they crack it, and they get good amount of money. And sometimes they don't get, and they don't make money. Then how can they make SIP in that?
There's an alternative to an SIP, which is called an STP. So whenever you get a lump sum, you park it in a liquid or debt fund and set up a regular transfer into equity and keep doing that every time you get a lump sum. So that's one alternative.
Really.
The other way to look at it is assuming it's SIP and lump sums may not be available for STPing. Look at it this way. If you make SIP a habit, you will find means to achieve that end. When demonetization happened, I had my security guy saying that biscuit खाने के लिए भी पैसे नहीं है. मैंने बोला चाय तो पीते हो ना? So the point is, अगर चाय की पत्ती के लिए पैसे आते हैं, तो कहीं से जुगाड़ हो जाता है. So I think this Indian system is expert in जुगाड़. It is very important to harness the जुगाड़ in right direction. When the mind decides, the body will find means to achieve that end.
I'll answer your question saying that I'm sure saying that whatever the amount of money that you're earning, you're not going to save the entire money in SIPs, right? You're going to only take 10% or 20% of that money that you earn to put it in an SIP. So if that is the way you planned your SIP, I think from the income that you accumulate, you're not going to spend everything. So I'm sure there is a bank balance which has a cash flow, which you have to match your cash flow with that kind of income and save only that much, which gives you that comfort to save consistently. I think it is all about planning.
So let's put our hands together for the lovely ladies. It's been a very engaging and a very, learning experience for me.
The second edition of SIP Day reassured retail investors about the protective measures of SIPs through a panel, Financial Freedom Formula, Save, Invest and Grow. The panel featured Harsha Upadhyay, Chief Investment Officer Equity at Kotak Mutual Fund; Yogesh Sharma, Founder and CEO of YS Capital; Dinesh Khemlani, CEO of Verity Fin Solutions; Dhruv Mehta, Chairman of the Foundation of Independent Financial Advisors, and was moderated by Senior Editor ET Now, Tanveer Gill.
The whole concept of save, invest and grow, which is the mool mantra that we are advocating here as a way to get into the markets, invest in the markets over the long term through the SIP route. And Dhruv, I want you to start off with your opinion on this. Is at a time when we do these discussions, the markets are really at highs, and we are still in a very good zone when it comes to the markets. But for most investors and most first-timers in the market, a day like this is when they raise the question of, should we invest in the markets today or not? Is this a good time? Because every time there's a correction, rather than investors getting confident about stepping in and buying dips, there's always a skepticism that will the markets go down further.
What we try and do is that try and address, okay, is this the money that you need over the next 5 years for any purpose? Do you need it for your living expense? Do you need for your short-term goals? You want to buy a car, you want to buy a two-wheeler. So what is the money that you need over the next 5 years? If there is any expenditure that you have planned or unplanned, that is the money which should not come in the equity markets. And I think if you explain that and the customer comes with that mindset that he is investing even a lump sum and the time horizon is, say 10 years, 15 years. And I think it's very simple if you point out to people that, like a lot of the young, now when I meet young clients and I ask them, what is your date of birth? Say if somebody is born in 1990, and then you ask him, do you know what was the Sensex in 1990? Most youngsters don't remember. So in 1990, in 1995, the Sensex was 3,000, 4,000. Today the Sensex is 30,000. And during that period, a lot of volatility has happened. The prime ministers have got assassinated, you have had, the war, you've had US. So a lot of things have happened. And therefore, over the long period, if you just give the simple message that over a 5-10 year period, the values are going to go up. And that is, what can help in overcoming the volatility. The time period, are you investing for a long term or you're investing regularly when the markets go up or down, it doesn't matter.
Right, like I said, the theme of this discussion essentially is save, invest and grow. Dinesh, how does one look at investing in the markets but also ensuring that over a long-term basis, they are in the positive or in the money?
The point being that we are all after this, that what have we saved? That is this 25 and 30%. And this is what is going for allocation. My question is, why is it always income minus expenses equals to savings? Why isn't it income minus savings equals to expenses? Let us first decide how much we want to save. If we decide that we can accommodate our expenses to match whatever is left. Having said that, when we talk of this 25 and 30% of savings that we as advisors go after, it's all about asset allocation and the goals that you have. So let's put it that I need some money, like Dhruv said, say for a 1 year period. It is very obvious that this money would not find its way into a high-risk asset class like equities. So effectively, what are you doing? Basis your goals, basis your risks. All that you are doing is allocation of money in different asset classes which meet your time frames, effectively 1 year, 3 year, 5 year, 10 year, 15 years. And if the asset allocation is correct, over a period of time, I do not believe that any investor would have lost money. And if an investor has lost money, then my humble request would be that kindly change your advisor.
Yogesh, just carrying that point forward, because at the end of it, you'll only invest the money that you save. And how do you make a prudent decision on saving right and then investing right?
I think it's going to be repetitive, that the time horizon, the time is very important, how long you want to save that money for. And based on that, then you decide what kind of instrument, that may be a debt, short-term, long-term, equity or a hybrid product that you go for. And then you understand what is the volatility of that product. So the time frame, how long you want to invest for and what is the goal. Once that is decided, then you just base it on which product. That's where an advisor comes in to decide whether it's a short liquid fund, a hybrid fund, an equity fund, and then you guide them on what the volatility can be on that product. That what can be the upside, what can be the low side. It's a day like an equity product. What you said, if you put in 100 rupees, it can go down to 90 even the next day. If your client and if an investor is well prepared and knowledgeable on that, then I think there's nothing to worry about.
Harsha, saving right, investing right, and then ensuring that the well-invested money grows. What is the right way forward on that front?
Yeah, I think clearly two things are very, very important. One is the asset allocation, and that you need to keep monitoring with your advisor on a continuous basis, and a long-term focus. Because if you don't have any of these two, I don't think you can sustainably create wealth. Since all of you know Sensex, I'll give an example about the Sensex levels. It started in 1979 and we are in 2017. So about 38 years. If anyone had invested just in Sensex and kept changing the composition of stocks as the Sensex composition kept changing and did nothing else, but just stayed invested in Sensex, in the last 38 years, the 1 lakh invested would have been more than 3 crore 15 lakhs and plus the dividends that you would have received every year. So possibly somewhere around 3.5 crores on an investment of 1 lakh. So I think the key, and in those 38 years, you have seen various events which are much larger in nature, much sharper in terms of correction, and there will be events which you can't foresee. But if you believe in Indian economy, corporates are going to grow profitably, and you are able to invest in those businesses for a long term, you are actually running those businesses by being shareholders. So that's what you need to think about. And as I said earlier, the key is asset allocation and the long-term focus.
If a person wants to start an SIP of 10,000 rupees, what is more advisable? 5 funds worth 2,000 each or 2 funds worth 5,000 each in different sectors, in mid, small, large, multi-sector, thematic, everything? What would be the suggestion?
Good question.
Okay. The basic idea is asset allocation, and if you're saying that this 10,000 rupees is going towards equity, all right, typically we'll just break it up probably into 3 funds. One is a diversified stroke large cap fund, one flexi cap stroke multi cap fund, and one mid and small cap fund. Means it's as simple as that. All right, you just allocate it evenly, and since this money is going to be for 10 years and 15 years, yes, 3 years down the line maybe the large cap will outperform, maybe 5 years down the line the mid caps will outperform, but at the end of the day you will average out at a certain rate, okay, which may not be equal to the returns that you have seen in the past.
Thanks very much for being here, and we hope in some small meaningful manner we were able to convince you to invest in the equity markets through the SIP route, the Systematic Investment Plan route. Thank you very much.
Next week, we bring you more from the second edition of SIP Day only on ET Now.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
A Times Influence Initiative.